Let's move on. Brennan, you are looking at, what are you looking at this week?
I'm looking at ATS Corporation. So yeah, it's kind of a
ATS.
nice segue, even just from what Brett was saying, where a lot of the times we see these serial acquirers just kind of growing their net debt and their net debt to EBITDA multiple. And here is one of those. So I will share my screen.
And was
And
it
yeah,
not at one point net cash when we
I
looked at
believe
this, right? Yeah.
so. I believe
You
so.
thought so. You're not gonna commit to
No, I'm not committing.
it. Brennan has a fear of commitment. That's what we're getting out of this.
True that. Okay, so yeah, we had a question come in a few days ago on ATS Corporation, and Luke says, "Hi guys, how about an update on ATS? They have had an interesting year. Thanks." So let's get right into it. ATS Corporation, ATS on the TSX, currently trading at a price of about $35.78, about a $3.5 billion market cap. And they are a global automation and technology leader that designs, builds, and services custom design manufacturing and assembly automation systems for a wide range of multinational companies in markets such as life sciences, transportation, food and beverage, consumer products, and energy. Over the past 12 months, 55% of revenue came from the life sciences market, 17% from food and beverage, 15% from consumer products, 8% from transportation, and 5% from energy. And over half of revenue is coming from North America. And looking at revenue by type in fiscal year 2025, 37% came from custom integration, 30% came from products and equipment, and 33% came from services, including spares. Now, the company has been a serial acquirer over the years, deploying approximately 1.8 billion of capital since 2018 through 23 acquisitions. So, it's quite the stark contrast where, Ryan was looking at Descartes, deploying 1.9 billion since 2009, I believe the slide showed. So, and across 50 acquisitions. So, they've been very, very aggressive acquirers here. And the last acquisition, which the company made, was in September of 2024 of Heidolf for euro 30 million euros, in the life sciences market. So they've really been focusing in the life sciences, as you could see, or as you can see on this slide. And as you'll see in my upcoming slides, the company has been primarily funding these acquisitions through debt. So we've covered the company a few times on the podcast and have written monitor reports for our clients. I wrote a monitor report back in November of 2022 at a price of about $45 per share, but it was really relatively pricey in my opinion, while it was trading at about 30 times earnings and 14 times enterprise value to EBITDA. The last time that we discussed the stock on the podcast was back in October of 2023 when Ryan covered the company. And the share price has almost been cut in half since its 2023 highs. But let's kind of see what the headwinds are and where the company is today. So looking at the last quarter, Q2 2026, ended September 28th, 2025. Revenues increased 18.9% year over year to 728.5 million. Organic revenue growth was 12.6%, which is strong, alongside a 3.9% positive impact for foreign exchange and 2.4% growth from acquisitions. Net income was 33.6 million, or 34 cents per share, compared to a net loss of about 900,000, or 1 cent per share a year ago. Adjusted EBITDA was up 32% to 103.7 million. Adjusted EPS increased about 80% to 45 cents per share, compared to 25 cents a year ago. Now, order bookings, they remain pretty strong, 734 million in the quarter compared to 742 million a year ago. And order backlog is robust, 2.07 billion, 13.5% higher compared to 1.8 billion a year ago. And looking at the valuation, looking at trailing accounting earnings, they are negative But the business trades with a trailing price to adjusted earnings multiple of about 22 times, a trailing enterprise value to adjusted EBITDA multiple of about 12 times, and a trailing price to cash flow multiple of about 12 times. So I would say that the valuations are certainly getting more attractive, than when we've covered it last and when I wrote that monitor report. But keep in mind it is a capital intensive business with EBITDA margins in the 14% range, and organic growth in the high single digits. Now, looking at the balance sheet, I believe the debt is sustainable, but it's currently at the higher end of my comfortable range, really, at 3.1 times trailing net debt to EBITDA. Management's target is to get it back between its target range of 2 to 3 times by fiscal year 2026 end. And again, we can see that here on this slide. This is from their investor presentation. The business really aggressively levered up, making acquisitions over time, and the company has been pretty good at not diluting shareholders overall. Primarily using debt to fund the company, to fund its acquisitions. But looking at the end of fiscal year 2023, they did issue some shares, raising about US 289 million. Now, moving to the outlook, backlog, again, I did say this before, but it was up 13.5% year over year, led primarily by energy and consumer products, but was offset slightly by the decline in transportation due to headwinds facing the EV rollout. We have seen that be a lot softer than originally expected. The business is guiding Q3 2026 revenue of 700 to 740 million in revenue, which is growth of about 10% over fiscal year 2025 at the midpoint. It's Q3 fiscal year 2025 at the midpoint. And management has indicated that they're looking for organic growth in the high single digit range for the year, which, considering they did 12% in the last quarter, pretty good. They're definitely on track. The business is also looking to restructure to help margins, anticipating total restructuring expenses of approximately 15 million through the rest of the year. So this is something to keep in mind in future quarters. So to conclude here, ATS is positioning itself to be a significant player in the automation industry and focusing on several intriguing verticals. Revenue growth has slowed in fiscal year 2025 due to a concentration in the transportation segment contraction in the transportation segment related to EV projects, but backlog growth is robust due to other verticals. Now, as I've mentioned, the debt leverage is high and above management's targets. The cadence of acquisitions also does appear to have slowed. They didn't complete any acquisitions in calendar year 2025. The other years, previous years, we had seen them make an acquisition basically every single year. So that is something to note. And really the question is this, growth at a reasonable price? It's trading at about 22 times earnings or adjusted earnings, and an EV to EBITDA of about 12 times, with organic growth of about 6 to 9%. That's what they're targeting. I do think that it's intriguing, but I'd really like to see them kind of get that debt under control. Even like when Ryan was going over Descartes, or Descartes, who I'm sure Ryan's going to butcher me afterwards for saying that wrong. But just seeing them, they've been able to maintain such a beautiful balance sheet, and maintain a great balance sheet, and deploy capital on acquisitions along the way. I'd really like to see ATS Corp focus on organic growth, supplement organic growth with a few acquisitions here or there, really pay down that debt. So that's really what I would like to see the business do. Other things to note: the second half of fiscal year 2026 may have some easier comparable quarters to stack up against in fiscal year 2025. But again, we will see some restructuring costs coming in the next few quarters, so keep an eye for that. Now, on tariffs, I didn't really mention much about tariffs, but a majority of the company's shipments from Canada to the US do fall under the USMCA. So that is good. And again, I do like the business. It looks a lot better than when I wrote up, a monitor report for clients a few years ago. But I just like them to get their debt under control. We'll see how they can do that over the year here, and continue to, focus on that organic growth. And that is it. That is all.
Descartes. I
Yeah.
think that's what I probably said it wrong the first time, but I
No,
think
no,
it's
I think you're.
Descartes.
I do think
I
you're
think
right.
it's isn't a French
I
philosopher or
should.
something like that
Yeah,
it's
and
based off of or something.
Mhm.
Yeah.
I
I
shouldn't
mean
even have
it.
said Ryan would butcher me for that. I should have said my French girlfriend would butcher me for saying it
There you go.
wrong.
That's fair.
Yes.
And rightfully so. You need to
Yes.
go home and show her what you did and
Oh, and here is the disclosure
disclosures.
as
Good
well.
idea.
Sorry, didn't get there.
Yeah, for sure. I mean it again, it's an interesting company. It's something that we we watch these companies try to grow by acquisition.
But yeah, the other thing interesting about ATS is really them being, even though it's not the biggest segment, is the nuclear part of their backlog. It has grown so substantially over the
It
past
has.
year. It's
Yeah.
109 million versus 277 now, so massive. And we've just been seeing such a buzz with nuclear becoming a trend, with AI build out being a potential source, all like the mini reactors and so on, and just general interest in nuclear. So even though it is a small part of their overall business, it could be an interesting portion of it. It could provide some tailwinds for the company.
Yeah, and what it does, all it could provide a higher multiple of people associated with that, and then there's excitement regarding nuclear. Then yeah, it could provide that, but we have seen just with these generally with the growth by acquisition stories. You have to be careful with your debt. You get these companies get excited to keep a growth rate at a certain level, and you see they're mounting debt levels to get it up to keep the growth rate at say 15% or above 15% every year. And if you just are going into too much debt to do that, and you start to get to a point where your debt to EBITDA levels are significantly high, then you have to stop that. And then suddenly the market says, but we want you to grow at 15% still. And then they can't. And now we're deleveraging. And then it can get into a vicious cycle. I'm not saying that is what is happening to ATS Corporation, but we've seen it happen many times in the past. So it's nice to see companies that, if they go into debt because you don't want to dilute, maybe they pay off that debt over time and do it a little more measured instead of trying to do it all at once. And that's what,
Exactly.
often what we see.
And that's the thing. Like, I'd really like to just see them kind of make more of a measured approach. Because again, when all of a sudden you're tapping up to, where the management is even comfortable, with their debt. Now all of a sudden we haven't seen any acquisitions, which is fine. It's totally
Yeah,
fine.
but I mean, that's the share price is flat or down over the past year, isn't it?
Yeah.
And that's the market's like, where's your growth? So,
Yes.
I mean, I'll juxtapose that with a company that we recommended earlier this year that is a boring U.S. manufacturing business that basically goes into debt, but then pays it off, goes into debt, then pays it off, or they pay off their acquisitions out of cash flow. And so you never see a share price increase, and you never get to the levels where at any point you're worried about them servicing their debt. And, instead of having a down year, that stock is up 80% this year, right? Crawford
Yeah.
United. And we've
Yeah.
talked about it before, but it's a company, boring U.S. manufacturing consolidator, but you see the share price jump over the course of this year, and that is because they made a good acquisition. By the end of this year, they'll probably have it paid off and start to be in net cash again and make another acquisition. But they don't need to make 10 acquisitions in a year. They're sustaining a growth rate that is a reasonable to significant growth rate with that acquisition they made, but doing it more responsibly and measured. And it's kind of the tortoise and the hare. Sometimes you see that, and everybody wants the short-term growth, but like the steady growth tends to be where you want to invest in over time. It'd be great to have amazing growth and a reasonable balance sheet, or a cash-rich balance sheet. Once in a while, we see that as well because it's all organic. But I mean, that's the best type of scenario. But if you're going to do growth by acquisition, it's a tight wire you have to walk. You have to do it responsibly, rather see it done over the long term versus trying to do it all at once.